forward to getting a chance to chat with Lance Roberts. He is the Chief Investment Strategist, RIA Advisors. Lance, Happy New Year. Thanks for taking time with us.
Absolutely. Happy New Year to you too.
I mean, I was just saying this week that all of the old stories from last year are still the stories for this year. Not a surprise. I mean, a couple of weeks doesn't make any difference, but can you make any forecasts at all without first starting with what you think the Federal Reserve is going to do in the U.S.? And in Canada's case, obviously, we have the central bank here too.
No. I mean, really, this whole market, for the last several years has not been really a function of anything other than Fed policy. It's certainly not traded on valuations. Certainly hasn't traded on fundamentals by any real stretch of the imagination. It's all been a function of what's the Fed going to do? Are they going to cut rates? Is it more monetary accommodation? And this whole rally that we saw from the end of October, where the Federal Reserve made their famous, pivot statement to a more, to not hiking rates anymore, potentially even cutting rates, that led to a 15% rally in the markets that had nothing to do with fundamental growth. It was strictly a valuation expansion. In other words, we just increased multiples in the S&P for that rally. So, yeah, it's all been Fed narrative and corporate share buybacks.
And let's keep going with that story in that the market says, what, we're going to get 5, 6 rate cuts, in the U.S., and the Fed, at least at their most optimistic, it seemed like 3 rate cuts. And they continue to say, or at least a lot of the Fed presidents were scrambling after Jerome Powell jumped in there and say, wait a second, it's not going to be that easy. But still, they're double what the Fed would say in their dot plots.
Well, not only that, but even the FOMC minutes that came out yesterday, or on Wednesday of this past week, even those minutes were not nearly as dovish as the conversation we've been getting from Jerome Powell. So, this idea that the market's going to get 6 rate cuts this year is probably not realistic. I mean, unless, and there is a case here to be made, that maybe the Fed is talking this game because there's a fundamental stress in the markets that we're not aware of just yet, at least the overall market. And I was talking with Michael Leibowitz just yesterday about this very same thing, is that if you go back to 2019, and so let's go back in the way back machine, all the way back to 2018 for just a second, because there's a very interesting similarity of something that may be going on. So if we remember, in September of 2018, the Fed was hiking rates. And in September of 2018, this is when President Trump was in office, the Federal Reserve said, we're nowhere near the neutral rate. In other words, the Fed was saying we need to hike rates more because of inflationary pressures in the economy. Well, at that point, the market sold off 20% between September and December of 2018. And this was where Donald Trump basically made overtones in the overall market that said, well, maybe I need to get rid of Mr. Powell because he's not playing the game. I'm paraphrasing. But, he was wanting, President Trump wanted rate cuts at that point to support economic growth and support the markets because that leads to consumer confidence. Well, lo and behold, by December, Jerome Powell says, now they hadn't raised rates, they hadn't done anything since September, but by December, it's like, oh yeah, we're at the neutral rate. We're good. We don't need to hike rates anymore. So a complete 180, the market takes off running. Okay, so that's a little bit of what's been going on now. In June, the Fed starts cutting interest rates, but there was nothing wrong in the economy. The economy was fine. Markets are doing fine. Why was the Fed cutting rates? It didn't really make sense. And then in September, the Fed starts doing this massive repo bailout, Fed repurchase operation that was going on. It was $1 trillion. And everybody's like, why are you doing all this repo? Now, we didn't know anything at the time that was going on, but there was stress in the financial system. Turns out later we were bailing out hedge funds like Citadel. But there was clear stress in the financial markets. And that was that fracture that we saw heading into 2020. And that's when we started talking about, we had an inverted yield curve. We were talking about the potential for a recession. The economy was set for a recession. And then we shut down the economy and caused the recession in 2020. So here we are today. Very similar situation. The Fed all of a sudden has made this pivot from higher for longer to, we need to cut rates. Everything's fine economically. So why would you want to cut rates here and risk having an inflation surge by having lower rates. But if we take a look at repo has been spiking. The cost of overnight loans are up over 6% now. And that's something that we haven't seen since 2019. There's been this very sharp tick up in what's happening in the overnight repo market. So maybe there's a financial fracture that is starting because of higher interest rates. The Fed sees this and they're trying to get ahead of it. That's my only explanation. It's all a wild guess at this point, but that's the only thing I can see out there as to why the Fed has made such a sudden pivot to cutting rates and risking a resurgence of inflation.
Yeah, when it first happened, that was one of my guesses or questions. Is there something
Yeah.
much worse out there? But I also add that repo problems in September 2019, I called it the biggest financial story of my lifetime that no one's talking about. I mean, because it was such a systemic problem. I mean,
Yeah.
the system was breaking. So it'd be fascinating to see. And there's lots of other examples as we went through from that time. I mean, I talk regularly about the bailout needed for the UK pension system when the central bank there had to jump in and buy those bonds. We know Silicon Valley Bank, again, the same kind of problems on the books. Japan, I spent a lot of time looking at Japan and I shake my head every time I look at it, but it's those internal financial things that don't usually make the headlines, whether, of at least the mainstream press. I'm still interested though. I mean, I was thinking this the other day. I can't imagine the retracement would happen if that interest rate scenario of lower interest rates doesn't manifest in a somewhat similar time frame. If for some reason there's a surprise, because I mean, look at the size of the bets made on that very thing.
No, you're absolutely right. It's actually, this is kind of a topic I'm writing about in this weekend's newsletter, which is, there is this disconnect between 6 rate cuts by the market, 3 rate cuts by the Fed. And if you're going to have to reconnect those two, either the Fed's going to have to become much more aggressive about cutting rates, which means something has gone wrong in the markets financially, economically, et cetera, which isn't good for stock prices, or stocks are going to get disappointed by not getting enough rate cuts, and you're going to get a correction because of that as well. So there's really kind of a painful conclusion that is going to basically converge potentially sometime over the next 3 to 6 months. Having another 5 or 10% correction this year in the markets wouldn't be surprising as markets try to reconcile this difference in economic outlooks. If the market gets into recessionary, starts to actually look at a recession, which doesn't look, that high of a probability at the moment because we have a tremendous amount of deficit spending going on that's supporting economic growth. But if the economy happens to really start tipping over into a recession, or we get a bigger contraction in employment than expected, that could manifest itself into a much bigger contraction to the markets, and of course, a much more aggressive Fed easing program at that point.
It's interesting with some economists I know and respect. I've been warning them for about since that repo problem in September 2019, that they're not looking at the right stuff. I mean, if they're making further forecasts about what's going to happen, because the credit markets are where the action is. The credit markets where the problems are in Japan and UK, as I said, going to be in the European Union, clearly across many of the emerging markets. It's actually what's the credit market saying that doesn't necessarily have to echo what the economy. And I think simply put, it's if I start getting worried, I'm going to get my money paid back, or I'm going to get my money paid back when I lend to government in much devalued purchasing power currency. I'm not even looking at the economy at that point. I'm worried about something much more straightforward. Am I getting my money back, and what will it buy when I do?
No, that's a very true statement. And you trying to use economics to manage a portfolio doesn't really work out well over time because economics are very lagging. They take a long time to manifest. And if you're trying to invest money and manage risk in portfolios, the things you want to pay attention to are things that are much more real time. Credit markets are very real time. To your point, if there is a concern about repayment of principal, you're going to start seeing credit spreads widen out very quickly. That's a surefire sign that something's going wrong in the financial system, and you want to get money out, into a form of safety. So, yeah, no, you're absolutely right. It's great to talk about economics, but when it comes down to managing a portfolio, pay attention to things that are directly related to systemic risk, credit spreads, volatility. Those type of things are much better way to understand what's happening in the markets and how that reflects to risk in your portfolio.
One of the other things you've been writing about is the sentiment aspect in terms of people are clearly paying more for the same performance or anticipated performance. I mean, we
Right.
call that price earnings ratios, but that's what they're doing. They're saying, hey, if you're going to still do that, I'll pay actually a little bit more for that. And that's, I guess that's a risk in the market, or at least that's something to keep a close eye on, because if sentiment changes, that could be the first to go.
Yeah, no, look, and this has been this has really kind of been a problem now really since 2009. In 2009 we changed the world financially. It's hard to understand just how much money has been thrown at, and I'm just talking about the U.S. Forget Canada, forget every other country in the world. I'm just talking about the U.S. People don't understand how much money has been thrown at bailing out and supporting and sustaining the economic and financial system in the US. It's $43 trillion. We're a $22 trillion economy. We've spent $43 trillion just since 2009 trying to support everything from the banking sector to the financial markets to the housing market, you name it. And that was all just to sustain 2% economic growth. It was a very, very poor return on investment. We've been spending $5 to $5.50 for every dollar's worth of economic growth over the course of the last 13 years. That's not sustainable. But what it did was is it lofted asset prices at a 4% increase over the historical average. So going back to 1900, from 1900 to 2008, the average growth in the S&P was about 8%. That's including inflation and dividends, the whole nine yards. Since 2009, we've had almost a 12% rate of annualized return. So we increased the annualized rate of return by 4 full percentage points over that course of that 13-year period by injecting $43 trillion into the system. The question investors have, of course, now 12% growth is exceedingly far beyond what the economy can actually generate. So we're talking about economic growth from earnings and profits in the country. So you're growing the markets at a much higher clip than what the fundamental value of companies actually are. And so you have to ask yourself going forward, how on earth are we going to sustain those types of returns in an environment that's growing at 2% with 2% inflation, which is what the Fed wants? You can't grow earnings to support that rate of return. So even a return back to normal average rates of return are going to seem very disappointing from what we've lived in over the past 10 years.
Let's talk about the U.S. debt for a second, just because it crossed the $34 trillion mark, which is a number. And yeah, exactly. It's a number. Well, both things, actually. It's a number so big, it's numbing and people don't know. But your response is the one that we've been observing here for a while. That, I may sit there and go, there's going to be consequences to the deficit. I think we should discuss what they will be. It's not some sort of automatic, the economy is going to crash or the world's going to come to an end. I'm more in that camp that says, well, Christine Lagarde of the European Central Bank said it a couple of years ago. She says, we can't go bankrupt here because we're just going to print the money we owe to people. And clearly there's been a lot of money creation going on, as you say, with the kind of numbers you were just alluding to. And I'm just thinking of, first of all, do you think it's significant? And what is the significance when, what is it, $2.5 trillion added to the U.S. federal deficit since the deal on the debt ceiling in June last year?
Yeah, it's a shame. First of all, just from a political kind of commentary standpoint, it's a shame that we don't have a group of politicians who are charged with managing the economy of the United States for 330 million people.
Yeah,
that we don't have a set of, and really, honestly, this goes for every country in the world. It's not just the U.S. But, this has become a very elite club of people that only look out for themselves rather than the welfare of the total economy. And it's a very sad statement to make because this is not what our founding fathers intended. And it's really not the way that governments around the world were ever intended to operate, at really kind of the behest of themselves rather than for the benefit of the global good. And, but when you start talking about the amount of the debt, right, 34 trillion, it's a mind-boggling number. But we have to look, you can look at Japan. Japan's running a 210, 220% debt to GDP ratio. We're about 120% of debt to GDP right now. So The easy answer is like, oh, we got lots of room to go. But the important thing to understand is that the more debt you have, look, just because we have 34 trillion in debt doesn't mean Armageddon's going to happen tomorrow. Doesn't mean I see all these articles, people are like, oh, de-dollarization of America, and the economy's going to collapse. You better have your bunker ready, better own gold, because that's the only thing that's going to make. And look, there's no evidence that we are to that point just yet. But what debt does mean, and the more debt you have, the lower your rate of economic growth is going to be, the lower your economic prosperity is going to be. And this is why when you take a look at the division that's going on in America right now, and America is clearly one of the great capitalist experiments in all of human history. And the what's going on in the economy right now is the ultimate end game of capitalism, where capitalism is no longer for the benefit of growing economic prosperity for all, but only for a few. And you're now seeing that wealth gap between the rich and the poor expand to the point that you're now getting this massive division of views within the economy. And that's all a function of the debt. Ultimately, it's the debt, because it's not just government debt we're talking about.
Yep.
It's also student loan debt. It's credit card debt. It's mortgage debt. It's all this debt. Because, and let me give you a couple of just numbers to bring this home very quickly. In the 1960s and 70s, the economy in the U.S. grew at about 8% on average. The average household debt to net worth was about 60% of debt to net worth. And the majority of that debt was the house, right? Today, the average debt to net worth is 150 to 160%. And that's on average. That includes the people at the top of the income stream that have very little debt. So you really kind of get down to the bottom 80%. Their debt to income, their debt to net worth ratios are far worse. But that's the problem, right? We've grown an economy on debt, which is not sustainable. And we need to come back to the point of growing an economy and reducing that debt so that we have more productive dollars going into productive investments, not going into debt service.
If you're worried about the U.S., you should see the Canadian numbers. Productivity per capita. I think the U.S. is at about 28,000. We're at 15,000. Translating using the currency. But of course, we've been stagnating much longer. OECD says Canada is going to be the worst performing on a real GDP per capita this decade. And then they said, if that's not enough, hasn't got your attention, let's do the next 3 decades. That's hardly but it's exactly the same problem as you described, which is, I keep thinking, is it just my recency bias that says that this is a very difficult, risky time to invest? I'm thinking geopolitically, at least, I don't feel people still seem to appreciate, when I look at the optimism, for example, in the markets, appreciate the geopolitical risk. They're aware of Ukraine, of course, they're aware of what's gone on with the Hamas attack on Israel, but also Taiwan is still, bubbling over there. So I started going, my gosh, there's all of that risk. And oh my gosh, it's escalating actually. And if one is following the news, it's actually escalating. Oh my gosh, we do have some consequences for that debt buildup, whether, as I say, it turns the purchasing power of the currency goes down, what have you. The list is a long one, but I don't know if it's just me sitting here today going, that seems unusual, or that's just I've just forgotten history.
No, you haven't forgotten history. The problem is really twofold. One, going back to what I said earlier, we keep electing individuals into office that keep doing the very same things. And, it's the old definition of insanity, right? Yep. I keep hoping that at some point voters around the world are going to wake up and go, I've had enough. I want something different. And we're going to try something different. But that all, and remember, all these political conflicts that we have around geopolitical conflicts, whether it's Israel or Ukraine or whatever, all derive from those that are running the countries at the top. It's not the citizens that are causing this problem, right? It's the government. So, and at the end of the day, it's about money, my friend. It's about spending. And the reason that our government likes war is because we make a lot of money at it, because everybody wants the weapons. And that's a very kind of callous thing to say, but it's just kind of a function of where we are. So when you start looking at geopolitical risk, we all have a very short recency bias now in the markets. Nobody looks at the long-term consequences of these actions. They don't look at the long-term outcomes of what would happen if China took over Taiwan tomorrow. what would that mean for the global marketplace? What would that mean for my place within the world if something like that would occur? We don't look that far away. All we look at is oh, the market went up yesterday. I'll better be in the market because I don't want to miss out. And by the way, we're talking about a very small percentage of people that actually invest in the financial markets, right? You take a look at the statistics in America. About 80% of Americans have less than $500 in the bank. Their average 401k balance is about $48,000 to $50,000. It's less than 1 year's worth of income. They're not invested in financial markets. They're just trying to scrape together enough money to get by. So we're really talking about the investing class. We're talking about the top 10% of income earners, which is becoming a much more narrow bracket, as the years kind of go on here.
Well, I'm proud to say on Money Talks, right from the get-go of the lockdowns and the pandemic, I asked questions about, well, what do you think the impact's going to be on lower income? It was so obvious that the policies that were getting adopted would only favor those with assets. Number one, real estate, which was a broader scale, and as you say, the small percentage in stocks. And it just seems still to this moment, we continue to ignore, as you said, the number of people, well, in the States, the numbers are just as big about who don't have a bank account or anything meaningful. They can't meet even 1 month's worth of expenses. Lots of ways to describe that. And I just think there's going to be massive social repercussions, especially when governments are putting in policies that do raise prices, that we've all experienced.
Yeah, but Mike, that's what I'm talking about. That's exactly what I was saying earlier. Is that you look at all the we want to talk about unrest in the United States, right? We got lots of problems, lots of division. It's not really the talking points that you hear in the media that's the problem. Those are things that people are latching onto. It's like, yeah, that's why I'm upset is because of this. But it's this underlying, disappointment more than anything else. But when you're faced with the kind of this crushing pressure of higher prices and lower wages and not being able to take care of your family, somebody gives you a piece of red meat, says, yeah, this is the reason why this person over here, or this group over here is like, yeah. And they latch onto that because that's the only way they know how to express their anger. Right. And we see a lot of that. But when you dig down into the root cause of all this has been really something growing since 2009, since the financial crisis, when this really started to root. And you had this division of wealth within the country. We had the 99% back in 2009. They were camping out on Wall Street.
Yeah,
and it's been going ever since. And from the cost of healthcare to the cost of childcare to all this other stuff, we're not helping those people. And to your point, right, we did all these handouts in 2020. We sent people checks. We gave them childcare benefits. We did all this type of stuff. And I said, that's a terrible idea because all it's going to do is create inflation, which is exactly what happened. And then when the money ran out, now the prices are still up. The prices don't come down when you create artificial inflation. They don't go back to where they were. The prices are still there, but they're out of money. And now the situation's even worse. And that's why the anger just keeps growing, and they just try to find people they can loft it onto.
Let's finish with this, and that's just okay. How do people going forward? What are you sort of broadly suggesting? Obviously, you don't know everyone listening's circumstances, but sort of broad themes. I'm very big about protecting our purchasing power because I just think I went to the bank a week or so ago and was getting some Christmas money. And it just seemed absurd the way they just kept on forking over like $20 bills. It's just pieces of paper. And it just, Of course, that's one of my themes. But I look at that going, this is just nonsense, or the U.S. now debating, well, let's give another $50 billion to Ukraine as if they had the money. No, they just have the ability to create it. So I am worried that way for individuals, as you say, especially, we're drilling down to the 75% of the public now, who is having trouble with this.
No, it's true. Look, and here now, here's the problem with all this, right? We had this really great conversation talking about the ills of America and all these economic consequences. And now you want to ask me a question about, what should you do with your money to protect against inflation? Well, you got in, and this is where the dichotomy comes in. There's only a few ways to outpace the rate of inflation. Honestly, gold didn't do it last year. Gold traded, it did okay, right? But it didn't really, and really going back to 2020 when we started having this big spike in inflation, gold didn't really offset your inflation risk to any great degree. The only thing that really offsets your inflation risk to any sustainable degree, unfortunately, was stocks. But you go, but Lance, stocks are all overvalued. Yeah, they are. But in a period like we're in now, that there are very few alternatives for making sure that your savings are outpacing the rate of inflation over time. And so we've got to take advantage of those. Yields on 10-year treasury bonds, they were over 5% last year. They're down to 4 now. So that trade is starting to go away in terms of being able just to lock in money at a higher rate. We're starting to lose that ability. So we're starting to get forced back in. And again, this is also where the Fed is. We're starting to get forced back into the stock market as the only real ability to offset or outpace the rate of inflation. Now, again, looking out over the course of the next 12 months, Mike, this is where it gets difficult. This may be the year that gold does fantastic, right? I don't know. I can't predict that far ahead. We can just make some guesses. But this may be the year that commodities. Commodities had a negative return last year as a basket. So they didn't help you offset inflation. But maybe this year's the year that commodities are the place to be. It's too soon in the year to make that call just yet because we're just now going through rebalancing. We're doing tax gain selling right now. But over the course of the next month or so, and maybe we can revisit, in the beginning of next quarter. But I think over the course of the next month or so, we will start to see the trends for this year begin to emerge. Where's the dollar headed? Where are interest rates actually headed? Where's inflation really headed? Or is inflation really heading to 2%? Or has the Fed created a potential for inflation to start rising again because of all this exuberance in the financial markets? People feel better. They go out and spend more money. That creates inflation. Those are the things that are going to start to manifest themselves over the next couple of months.
Well, it leads beautifully to me say we will visit again in the near future to do that. But they can also visit with you every day, realinvestmentadvisors.com. You do a blog, you've got a newsletter people can access. So as this develops, because I couldn't agree more that I'm part, know the World Outlook Conference. It starts February 2nd and 3rd. Why? Because we get some of this data to make it a little more certain at that point. If certainty may be the wrong word, but more information. But they can go to realinvestmentadvisors.com every day and then look forward to your next appearance on Money Talks, as I will. Lance, thanks for finding time and a happy new year.
My pleasure. Thank you so much.